Welcome to the Boyk Brief, a production of the Charles Boyk Law Offices in Toledo, Ohio. Join us as we explore real legal cases, talk to fascinating people in our area, raise awareness about community initiatives, and share helpful information about protecting yourself and those you love.
So we're happy today to have with us, in my opinion, the top financial advisor in Northwestern Ohio, Mike Nusbaum. Mike has been my personal financial advisor since 2002, and he has exceeded my wildest expectations. The thing that I'm most impressed by Mike is Mike originally came to me and he underpromised and overdelivered. I don't really trust people who promise me the moon and then don't deliver. Mike underpromised, and I think if he would have told me what the results actually ended up being, I might not have believed him, but he underpromised, he overdelivered, and I think his words of wisdom may be helpful for you. Mike?
Thanks, Chuck. Thanks for those nice, kind words. Good to be here today.
Yeah, so Mike, what I wanted to do initially is maybe identify yourself, your occupation, and maybe tell the people a little bit about your story, how you ended up, being a financial advisor and what you do.
Sure. I'm from Sylvania. I grew up in the Toledo area. I went to high school at Sylvania Southview. From then I went on to school at Ohio State University, graduated in 1986. During that time, in college, I was really going to lean to go into law school. My father was an attorney, and I thought that might be the direction I was going to go. However, as I got along farther in my undergraduate studies, I really wanted to focus more on the business, and law school didn't appeal to me as much. I knew a couple financial advisors that I had known for years as a kid growing up. And so when I was getting about a year away from graduating, I had spent some time with them, picked their brain. The business really intrigued me. It really kind of grabbed me more than anything else. So that was really, at that point, I decided to go into the financial services industry. And once I graduated, I again pursued a career in this industry, and I have been in the financial services industry since 1986. I'm actually going to be celebrating my 35th year in the industry next month.
So, Mike, I have a lot of just different questions that I think people would be interested in. First question is, you get a lot of people, they manage their own finances. Should you manage your own finances, or should you hire an advisor?
I'm always under the opinion that you should hire an advisor, and for a lot of different reasons. It's hard to be an expert in everything, and especially financial service issues. An advisor can really bring out different areas that people may overlook. Today the world is so complex, and you're dealing from everything from college funding for your kids to retirement planning to how to purchase a home, insurance planning. So you have so many different facets of financial planning that I think it would be overwhelming for somebody who's not living this, not doing it as a profession, to try to manage their own investments. It's a very complicated business, and to have things done the correct way and the right way, you really need an advisor. The other thing, the financial advisor can bring ideas, different tax saving strategies, education strategies for your kids that most people, and quite honestly, don't know about, don't understand. Without an advisor, many times they would just not have access to these type of things. So I think it's always important to have an advisor, have somebody that you trust, and also the the thing that people want to understand is that a financial advisor works with somebody's accountant, somebody's attorney. So it's a pretty much like the quarterback of your professional team. And so, yes, I think it's very important to have that person to work with and be available.
And I guess my point to that would be probably 2 or 3 of the best investments that you've ever put me into were concepts that I had never even heard of. So I didn't even know they existed. So I certainly wouldn't have done them on my own because I didn't even know they existed. How should you go about picking an advisor?
That's a great question, Chuck. I think the best way to pick an advisor obviously is a referral from somebody that you trust, somebody that's already done business with that advisor, somebody that has that has credibility. A lot of times you earn that credibility through working with somebody. So, if you can get, I think a referral to somebody that's already working with somebody that that's always obviously the best way. The other thing, I think you want somebody that has a clean record in terms of, no citations, no issues on their broker check. So there's a website called Broker Check where you can look up an advisor, see if they have any FINRA problems. Obviously you don't want to go to somebody that's had some issues in the past with FINRA. And somebody that's basically been in the industry a while. I think that's important. I think experience in this industry is very important because it takes a long time to really understand this business. But I think those are the things that I would look for in an advisor.
One of the things I'd also add is how responsive are they to you? So one of your best qualities is I don't have to worry about you taking 2 or 3 days to get back to me. Normally you get back to me within like an hour.
Yeah.
Might be a long period of time. And I think a lot of us, you're in the customer service industry, so am I. Responsiveness to your clients is absolutely crucial. And I think you're an A+ in that area. And I've been involved with numerous other people that I'm still waiting for the return calls years later.
Yeah, and that's, I think that, and I appreciate that. I have a good staff, and I think we really want to get things out quickly. I mean, if we get an email or a phone call from a client and it's a service issue, our goal is to really get that done, as quickly as possible. So, just before I got on this podcast, I had a client call and, had a couple service things, and my assistant will get on that. She's already probably doing it as we speak. And that is important. People want responsiveness. They want to be able to communicate. You're right. I was always told, my father told me, there's really no reason that in this day and age, especially, that you can't return a phone call within 24 hours. So we're a lot more available than with cell phones and emails that you can be very responsive. There's really not an issue. There should never be an excuse for not being able to return somebody's call or email.
Okay. Let's talk about financial advice. Young person, just graduated from college, maybe thinking of getting married or starting a family. What should they do from a financial perspective?
Well, I think that's a great question. When I talk to a young person starting their career, just graduated from college, I think when you graduate and you start in the world, really good habits start early. And I always tell a young person that you really should get into a good financial habits. And that means if you're in a company that offers a 401k, put money in the 401k, get used to saving money. I always use the term with people, pay yourself first, okay? Because we all know we have bills, and a lot of people, what they do is they pay their bills and then they have nothing left. But I think if you get into the habit of, even if it's a smaller amount to start, pay yourself first. Get in the habit of putting money away, because it's a lot easier to save money and get into good habits when you're younger than when you're older. The other thing is you have time on your side. So somebody who's 22, 23, who gets into the habit of putting money away is going to have a lot more money when they retire, when they get older. It's very hard to play catch up when you start saving when you're in your 40s or 50s. You really have to put a lot of money away to make up for all those years that you didn't put money away. So I think, one of the things I would say is get into good habits, meet with somebody, get a plan together. Again, and even if it's not a lot of money, it's still you're developing the habits that are going to make you successful.
Okay, so now our young person has gotten married, has 2 young kids. Best advice for a person who's your client who has little kids?
I think again, just still get referred, from my clients who now have kids that are, starting out with young families. I think it's really important when you're married, starting a young family, is to the first thing I think the foundation of a financial plan is life insurance, disability insurance. Those are 2 things that are critical. Why? God forbid somebody has that bad day when they're young and they have a small family. Without life insurance, without disability insurance, that could just devastate any sort of financial plan, put people in deep debt, bankruptcy possibility. You're losing an income potentially. So I think the building blocks of a strong financial plan are insurance. I've had many situations, unfortunately, but fortunately, where I had clients that were disabled at a young age, but thank God they had disability insurance. They were able to maintain their standard of living. I've had clients who had young families, young children who passed away at a young age. And I've had kids reach out to me and said, I'm so glad that my dad bought life insurance from you because I'm able to stay in college. When you get those kind of messages from a 20-year-old or a 21-year-old, it really makes your job very satisfactory, and you feel great about what you did. So I think you need to really plan from that standpoint. Start with even if it's some term insurance, make sure you're covered, or a small disability policy, because those are the 2 things that can really put your life in chaos.
Okay. Everybody's heard the concept of a 529 plan. You got me into a 529 in 2002, and college became not a problem for my kids because of that. Explain the concept of the 529s and what you should do.
Sure. The 529 plan is a way for parent, grandparent to put money aside for their children or their grandchildren on a tax favored basis. And what I mean by that is when you put money into a 529, the parent or the grandparent is basically the owner, custodian of that money. The child is the beneficiary. So what happens is the money gets invested typically in a mutual fund for the use for education, typically for college funding. And the great thing about the 529 is there's no tax on the earnings as the funds are growing. And when you use the money for education, there's no tax. So these funds are specifically to set up for education. The other thing people say to me, well, what happens if my son just decides, or daughter decides not to go to college? What happens to that money? And that's a great question. If you have other children, you can transfer the funds to the other child or the other children, and they can use it for their. Chuck, we've done that. You can. That's the best way, obviously, because if you don't do that, obviously, we're going to have some issues in terms of getting the money out. There's a 10% penalty. So my whole thing is use it for education. And if there's money left over, transfer it to other children or grandchildren so it can get passed down through the family. But that really is the best way, in my opinion, to save for college. You know, it's earmarked for college. You know what it's for. And with the tax strategies and this tax savings, it's the best way to save because of the tax free distribution for education.
Okay, next concept we want to talk about is the 401k. You run my 401k plan for my law firm. What should everybody know about a 401k, and is that something for them?
Sure. So, 401ks have obviously been around for a while. They've really become, I would say in the last 20 years, very, very popular because for a number of reasons. The old days when people worked for a large company, typically the employer would have maybe a pension plan. And that would really take care of a lot of the employees. What happened is that a lot of those plans went away and companies implemented 401ks. The great thing about 401ks is the employee can participate. The employee is able to put money aside from their paycheck either on a pre-tax basis or an after-tax basis. So what does that mean? That means that if an employee is putting money away on a pre-tax basis, the money that's taken out of their check reduces their taxable income. So that money is coming out, reducing their income. It's going away for retirement. And the great thing about it is the employee doesn't miss it because it's coming out of their check. It's coming through their payroll. The money is going to the investment company and they're not seeing it. If they had to physically write a check every month, it would be much more difficult. So it's doing a couple things. If you're doing on a pre-tax basis, reducing their taxable income, and also it's going in for retirement. We have Roth IRA 401ks where you can make an election to put the money in after tax, and when you go to take the money out as an employee, that money comes out tax-free. There are limits for how much you can put in depending how old you are. If you're under 50, it's less money. It's $19,500 a year. If you're over 50, it's $26,000. That's the max that you can defer. And a lot of times people say they'll hear matches, they'll hear profit sharing. So many employers, they will implement a match program where if the employee puts in a certain amount, they will match dollar for dollar up to a certain percentage. Some companies have profit sharing. So if they have a good year and they want to put in additional monies, they can do that. So there is incentive because, if the employee's putting in money, a lot of times the employer will put money in as well. So they'll be getting money from their own checks, but also they're getting some money from the employer. And it's like I said, it's very important because it's a vehicle that many companies make available. It's easy to participate. The money is out of your hands. You don't touch it before you're spending it, and it's going to reduce your taxable income. So I really encourage when I go to talk to my clients and their employees, I really stress, take advantage of this. It's available. It really is going to benefit you in the long term. And I think it's important for employees to really participate if their employer is offering it.
Next question I have is concerning life insurance. You touched on this briefly, but what are the different kinds of life insurance, and maybe in the short story, how could you best use them?
Good question. So the life insurance industry has changed greatly, and it's greatly in even the last 35 years. when I see somebody that's starting out, they're not making a lot of money. They don't have a lot of extra money. A lot of people will buy what they call term insurance because of the inexpensiveness of term insurance. Term insurance is really made for somebody that wants to get a good amount of life insurance, but they don't really, maybe can't afford what we call permanent insurance, whole life insurance. But the term insurance is going to protect their family. They're going to get a lot of insurance for not a lot of money. The other thing with term insurance, the upside is that it's inexpensive and you can get a lot of coverage. The downside is that it's only guaranteed for a duration of years. So there's typically 10-year term, 15-year term, 20-year term, and 30-year term. It's great when you're in those guarantee periods, but the problem is, people are living longer. They live beyond the guarantee periods, so they can actually run out of that coverage because they've exceeded the duration of how long the term goes. So a lot of times what I'll see is, people will get close to having that policy expire, and they're going to have to either convert it to another type of insurance, or they're going to lose the benefit. There's also, many people know, they've heard the words whole life insurance. They've heard the words universal life, variable life. Those are more permanent type of insurances that build cash value. And, a lot of times people will use them for supplemental retirement plans. And the reason for that, Chuck, is that, insurance offers some great tax advantages. When you pull the money out at retirement or whenever, using withdrawals and loans, the money that you pull out of a life insurance is income tax free. So a lot of people will use it for a additional bucket of retirement money, and while they're pulling money out, if something happens to them, the death benefit goes to their family. So there's a lot of uses of life insurance. It's not only just, hey, if I die, my family gets money. There's also a lot of living benefits with it. The other thing that's become popular over the last 30 years is what we call variable life insurance, where the cash values are in equity and bond sub-accounts. So the client can have some control how their cash value is invested, and as opposed to a whole life insurance where the insurance company basically has control. They're paying dividends, and the cash value is determined really by the insurance company and their mortality expenses and so on and so forth. So there's a lot of different ways to do it. My suggestion is if you have an advisor, you sit down and let him kind of see what the best fit is. Every person's different. The key is everybody needs insurance. It's, having the right amount of insurance and what really is affordable.
One of the things you pointed out to me that I thought was important was everybody wants to buy insurance after they have a serious illness. But obviously, the time to buy insurance isn't after you've been diagnosed with cancer or heart disease, because you're probably not going to meet the eligibility requirements. So the time to buy insurance is when you're healthy, not when you're not healthy. Yeah,
great question, and your great statement. I mean, absolutely. And I think really, and we've talked about this, I think, the earlier, again, you buy insurance, for that reason, your insurability is obviously always going to be better when you're younger than as you get older. As you get older, you develop health issues, and it's harder. You're older, so the insurance costs are higher. You have problems come up health-wise. When you're young, it does a couple things for you. You lock in that insurance death benefit. You lock in your insurability. The other thing is, just like when I talked about earlier, a young person that owns insurance, it provides another way for them to save money that they can utilize down the road as a supplemental retirement plan. And I've used that for a lot of kids. I have my own child. My dad had it for me. So I think it really is a good way for a young person to see the benefits of starting early and having their own policy when they're young.
Mike, how often should you be meeting with your advisor?
That's a good question. What I do with my clients, I kind of put that, we ask them, we'll say, how often do you want to meet to review your circumstance and your investments, insurance, so on and so forth. We have people that we have quarterly meetings with. We have people that we have semi-annual meetings with. We also have people we have just an annual meeting with. At minimum, we're going to meet with our clients at least once a year. I like to meet with them. I like to stay in front of them more. I think quarterly or semi-annual is really a better way. It just seems in this day and age, things change a lot more than once a year. Even if it's a 20-minute, 30-minute meeting, once every 3 or 4 months, I think it's, my thing is I think quarterly is the best. You just stay on top of things. Again, there's so much to go over. A lot of these meetings, we're going over, and Chuck, this, we're going from investments, retirement planning, college planning, insurance planning. It's a lot of information and a lot to cover only doing it once a year. So I think at least quarterly, semi-annually, but quarterly would be my preference.
And we're trying to do a 20-hour thing in 40 minutes or so. Disability insurance, long-term care insurance, where does that go in your financial plan?
Again, I think very important. I've had some friends, clients that have been on claim and on a disability basis. Those policies kept them in their lifestyle. Without them, they would have been in bad shape. When you're working, your disability is protecting your income. We insure our homes, we insure our cars, we insure our businesses. But the most important thing is us. We are the thing that makes all that happen. So our ability to generate an income needs to be protected. And somebody that doesn't have disability insurance is really hanging themselves out to dry. God forbid they get an accident or they develop a health condition and they can't work. Where's that money going to come from? And let me back up a minute. A lot of people ask me, well, I work for a company and I have disability insurance. Okay, most disability coverage through an employer plan covers 60% of your salary, does not include bonuses. So many people are paid majority of their income on bonuses. That's not covered under a disability group policy. The other thing is the benefits of a group policy that's paid by the employer is taxable. So that people really don't understand that. When we meet with them, we say, understand if you're getting $5,000 a month from an employer plan, that is taxable. Whereas an individual policy that's paid by the individual is tax-free if you receive it, if you go on disability claim. So very important. Long-term care, I think, is becoming more and more of an issue. I've dealt with it with my father. I've dealt with many clients. Disability is to protect an income. Long-term care you get for two reasons, in my opinion: to protect the assets that you work so hard to accumulate. So if you go into a home or your spouse, that insurance is going to pay to put, whether you need a private home, nursing home, whether you need assisted living or in-home, that insurance is going to pay that much better than coming out of your assets that you work so hard to accumulate. So that's really it. You're insuring that as opposed to going in, depleting assets to pay for this stuff. So I think it's just good financial sense. A lot of people, once they hit 60, 61, 62, they've been paying all these years for a disability. really doesn't make sense to own it anymore. Why? They have enough assets, and typically, if they get disabled, their policy is only going to be paid to 65. So if they're 62, 63, what's it really the benefit of a year or two? I'd rather have that money go towards a long-term care than disability at that time.
Mike, we see on TV on a regular basis ads about the concept of annuities. How do annuities work, and who are they proper for?
Yeah, so good question. That industry has really changed a lot. The annuity world has changed immensely. There are different types of annuities. There are fixed annuities, which offer a guaranteed interest rate. Interest rates, obviously, we all know have been very, very low right now. So those rates are very low and not really super attractive right now. There's index annuities, which are tied to different indexes. And then there's variable annuities, which are tied to the markets, are tied to the stock market or the bond market. Those are really the most popular. I was with a client this morning, and we were having a conversation. I think annuities represent a good financial strategy in the terms, in the sense that if you use them properly, they really fit well. A lot of people that I deal with, their concern is in retirement, they have, whether they have mutual funds or managed money, what happens if my account goes down and I'm taking a certain percentage every year, every month, and I have X amount of dollars one year, but my account goes down 20%, but I'm still taking that same percentage. Well, we all know what could happen, that you could run out of money because you have less value, and you're drawing that same interest off less value. Where the annuities come into play are a lot of these annuities now have income riders. And what's nice about the income rider is that they're going to provide a guaranteed income for life for somebody. So if you really back up, what things are guaranteed that we in our life? I think there's really easy. Social Security. Most people know that they're going to get a Social Security check. It's going to be the same amount every month. They're going to get that monthly, depending what age they take it. It's going to be a monthly check. Maybe they have a pension plan, from an old job. That's paid monthly. The other thing that's paid monthly is a living benefit from an annuity. So what I find is that clients that are in retirement, that are turning those income streams on, they love that because they know every month that check's coming. They don't have to worry about the market going down. That money's going to be paid to them. Whatever happens to the market is irrelevant because they're getting a guaranteed income stream.
So, Mike, there's so many different options available to the average consumer: stocks, bonds, mutual funds, managed money platforms, cryptocurrency.
Right.
I mean, we could just buy baseball cards. What should the average individual do? I'm assuming it's so complicated. How could you possibly know what to do without an investment advisor? And I see all these people basically buying cryptocurrency and then losing their shirt, and I kind of just shake my head.
Yeah. It's funny, Robinhood, it's been on, they're going public. So, you see a lot of these young kids today, they're opening these accounts and they're trying to buy stock, and, it's the get rich quick thing. Buying individual stocks is very risky because why? Most people don't have the knowledge. It's all, a lot of it's just, hey, I like this company. I like this company. But you're right. I mean, if you don't know what you're doing, you can lose a lot of money. And the thing about individual stocks is, those are more volatile. Why? Because you're buying potentially one company. If you buy one stock, if you buy Apple or Google or whatever it is, you're all in on that company, and if that company has bad earnings or something happens, you're going to lose value. I think that when you meet with your advisor, the key is what's your risk tolerance. When we meet with somebody, we kind of look at the risk tolerance, what makes sense, and you know what, they may own some stock, they may own some mutual funds, they may own annuities, they may own managed accounts, but we really look at what fits their situation. It's not a one size fits all thing. We really go over what's the goals, what's your risk tolerance, what's your time horizon. That's another thing. If you're going to be in equities, there's going to be ups, there's going to be downs. You're going to have good years, bad years. But if you're, so how long are you planning to be in these investments? That's also very important because, some people think, hey, I'm going to get in, get out. Most of the time that doesn't really work if you're trying to time. There's no, market timing. It just doesn't work. You really have to stay in, buy in, keep putting money in, and really be in it for the long term. Somebody wants to open a Schwab account or a Ameritrade and take, a few grand and have fun. That's okay. But in terms of a financial plan, you really need to sit down and say, what am I trying to accomplish? And how am I going to accomplish it? And what's the best investment for me to accomplish it? And, but you're right. There's so much out there, and, you really, because when the market's up, everything's great. But when you're going to have years where where the market's not always going to be up, and you need to be diversified. And really, that's what I try to stress to my clients. Diversification is the key.
So, Mike, if somebody wants to contact you, what would the best way to contact you, and what type of individual would you be willing to work with?
They can always call, my company's Premier Wealth Management. They can contact me via email. They can call me. My phone number is 419-740-4023. And my email is mnusbaum, that's Nusbaum, @financialguide.com. Feel free to email, call me. Everybody, I like people. I like to help people. Everybody's situation is different. That's why I love my job. Every day is different, but we're really helping people. I had a lady in here, unfortunately, lost her husband recently, 46 years old, suddenly. She really has needed help. She was lost. And, you feel great about somebody when they leave here. They said, God, I feel so much better. I'm so glad I came to you. But, every situation is different. We like to help people. I like to work with people. So that's really it. I mean, ideal client is somebody that really wants to, help themselves, and if they're willing to sit down and talk and see what's on their mind, I'm happy to help anybody.
Thanks, Mike. I appreciate you giving us all of this information. And once again, Mike has my highest recommendation. Me and my family owe pretty much all of our financial health to Mike.
Well, thank you
very
Chuck.
much, Mike.
Thanks, Chuck.
Thank you for joining us on the Boyk Brief. Tune in next time for more stories of law and life.